Well, it's Friday. You know what that means? Homework time, homework review. Is there a life where you guys dream like there's no homework and you just have Fridays off? Is that kind of the goal? Yeah. 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 Guess what? In the real world, you'll have something more serious than homework. You'll have actual work. So, speaking of work, some reminders. A week from today, your Excel assignments are due. I've been reminding you consistently about that. I will probably harp on you a little bit about it next week as well, but I shouldn't have to. Hopefully, you've started by now. If you've not started by now, start. All right. Please make sure you do not wait until the last minute on this. If you wait until the last minute, I will have very, very minimal sympathy. I always have a little bit of sympathy, but it'll be small. Will be very, very small. Not enough to count for any credit in this class. Let's put it that way. So please start working on this now. If you haven't started working on it, get started this weekend. I know that you probably have other stuff that you got to do, but I have been telling you about this for a while. So please make sure you get working on that. Also, group presentation topics. I did mention that we're going to have a group presentations that are worth more. So probably want to start thinking about the group presentations now rather than later, especially since you'll probably be doing some of your preparation over the week of Thanksgiving, given the way the timing works out. So group presentation topics, we have one group that selected a topic. They selected current technological trends in auditing. Everybody else in the hall here, what I say. We have one group selected current technological trends on auditing. So that topic's been taken. So the other two groups, you can select those. Close the door just exactly the wrong time, I tell you. Anyway, please reach out to your group members, say what do you want to present on. I'd like to get that resolved by the end of next week. So please make sure that you talk to them and figure out what it is you're going to be doing. Also, with the group presentations, please make sure that you take a look at my presentation guidelines. That is kind of, for this course and for my courses, for any course that you take with me, that is the holy grail of the presentations. You follow those rules. And I don't care if they're inconsistent with Dr. Otero. Dr. Otero is not the boss here. I'm the boss. Unless she shows up, then she's the boss. Okay. But as long as she's not here and I can make her stay away because it's auditing, I'm the boss. All right. So that's going to be the guidelines of that. And please make sure you check the schedule. Just anything else to do. I think there's only minor stuff, but we do have another exam coming up in a few weeks. We got professional interaction submissions that are due. So a lot of stuff coming up. If you do not pay attention to it, let Brightspace remind you, then you'll probably only get 48 hours notice. That's why I'm trying to make sure that everybody's staying on top of these things now, because some of these things may take you longer than 48 hours. Not aggregate. I'm just saying that, you might need more than a 48-hour period to work on something. So again, that comes out wrong no matter how I say it. I keep trying to make it sound like that it's going to take less time than 48 hours. Nothing in this course should take you 48 hours to complete, okay? But you may want to have more than a 48-hour window to complete something. All right. With that confusion that I've completely created and hopefully mass pandemonium, not mass pandemonium, let's get it started on some homework. All right. Chapter 10. For the control activities to be effective, employees maintaining the accounts receivable subsidiary ledger should not also approve what? So keep in mind here that we're looking for something that's in the revenue process that does not contradict the approval of, not contradict with maintaining the accounts receivable ledger. So maintaining the accounts receivable ledger, that's a recording function. So we're looking for somebody who's approving, which would be an authorization function, but it needs to be authorization that's within the revenue function. Now, we can actually eliminate A and D pretty easily. Employee overtime wages and cash disbursements. Employee overtime wages, that's going to be in the payroll function, which we're going to discuss next week. And then cash disbursements, that's purchasing function. So we have credit granted to customers and write-off in customer accounts. Now, both of these are things that I would honestly like to have segregated out. But if I were to have one that I absolutely have a necessity to segregate it out, that would be write-off to customer accounts, okay? Because write-offs to customer accounts very directly affect accounts receivable amounts. So again, if you answered B is probably something that I would not be comfortable with. I would not want to have somebody who's maintaining the accounts receivable subsidiary ledger and authorizing credit granted to customers. That's a reasonable conclusion, but I think C is a little bit cleaner answer in this particular regard. Question 1013, which of the following controls is most likely to help ensure that all credit revenue transactions of an entity are recorded? By the way, are you all getting sick of these most likely questions? Yeah, they're not going anywhere, but I just wanted to check and see where you're at. Yeah. I don't like most likely questions either, but that seems how they do. So credit revenue transactions are recorded. All right. So what assertion are we dealing with? So what's our recording assertion? What is one of the first three assertions that deals with recording? Completeness. That's where we're going. Completeness. Okay. Yeah. Completeness. So let's go ahead and work through each of these and see which of these actually matches completeness or kind of follows this pattern. All right. The billing department sends a supervisor a copy of each approved sales order to the credit department for comparison to the customer's unauthorized credit limit and current account balance. All right. So basically, we're starting with a sales order and we're moving down to see with the credit. The system itself has the credit information system, which is originated. So we're moving here, moving down. We're moving from top to bottom. That's vouching, right? Okay, or that would be the direction. It's not. This is not actually a vouching test because this is a control, but that's the direction we would assume with vouching because we're going from top to bottom. What assertion does that usually deal with? EO, the existence current. So it's not A. County department's supervisor independently reconciles the accounts receivable subsidiary ledger to the accounts receivable control account each month. Um, this one is a little bit challenging, but this one does not sound like a completeness test. This sounds more like a VAA test because it would be something that would be done at the account balance level. That being said, I don't think this completeness test in any regard would look at it. So C, accounting department supervisor controls the mailing of monthly statements to customers and investigates any reported differences by customers. All right. So this one actually could be a couple of different assertions, but is either of them going to be completeness? Probably not. This could potentially be EO, existence occurrence, because we could have fictitious customer accounts that have been created. This is a way to verify that we don't have transactions that are fictitious. This could also be VAA. We could make sure that the balances the customer's reporting are correct. Okay, but neither of those are completeness. The billing department supervisor matches pre-numbered shipping documents with entries in the sales journal. Okay, so what's going to happen here? We look at the document numbers. We see the sequence of numbers that should be going. We look at the sales journal. We have document number 1, document number 2, document number 4. What happened to document number 3? So we look at where the documents are. We see what was recorded. We're moving from here to see if something was not properly recorded. That sure sounds like completeness to me. Plus the direction is right. We're moving from bottom to top. Okay. So in this particular regard, D is our answer. This one's a pretty interesting question. It's a challenging question. It can be a little bit confusing, but I think this is a good test of knowledge of the assertions and application here. 1017. If accounts receivable turnover, credit sales over receivables was 7.1 times last year compared to only 5.6 times in the current year, it is possible that there were what? Now, this is an interesting question. This is an interesting question as far as what's going on here, because we have to note that what happened is that accounts receivable turnover decreased from the previous year. Okay. It was 5.6 times this year, 7.1 times last year. So what could happen to these numbers that can make the result lower? Okay. We could actually have a decrease in credit sales. So a decrease in the numerator would decrease the result. So credit sales went down, or receivables went up. An increase in the denominator will actually decrease the results. Everybody with me so far? So we're looking for a result that either decreases credit sales or increases receivables. Decrease the credit sales and increase the receivables. All right. Now, interestingly, there's actually two possible scenarios that could be answered here. And this is something I discovered after a long time of using this question. One of them was very clear to me, and the other one came up. So unrecorded credit sales in the current year could actually potentially decrease credit sales. So if they were properly recording credit sales in the previous year and then failed to record credit sales in the current year, it's possible that could decrease credit sales. Now, is that possible an answer? If you circle this, if I ask you this question on the exam and you circled this, I would count it correct because technically speaking, this would be a result. This is unlikely, though. This is an unlikely scenario, though, as it's unlikely for many organizations to fail to record sales. It's just not something that many organizations do. So let's go down to D, fictitious sales in the current year. So if you're operating in credit, what happens to your receivables balance if there's fictitious sales? Well, you generate a receivable. Then you say, I'm going to collect that receivable. You never collect the receivable because it's a fictitious customer. They're not a customer who will ever send you money. So what happens to your balance over time? It goes up, okay? Is that a legitimate concern for many organizations? Fictitious sales? Yes, okay? So both of these could actually be a result, but D is going to be the more likely scenario, all right? Now, I do want you to think about this. I want you to think about these relationships, but it's also important to think about what is our biggest concern with respect to auditing. If I was concerned about what the most possible scenarios, the most likely scenario that this would happen, I would be more focused on fictitious sales in the current year than I would be about unrecorded sales in the current year. All right, question 1021. The negative form of accounts receivable confirmation is particularly useful when what? Let's just talk about negative form. Positive form says, send me a response no matter what, okay? Send me a response no matter what. Negative form says, send me a response only if there's a problem. Which provides the higher level of assurance, positive or negative? Positive. Positive level assurance or positive form provides a higher level assurance. So obviously, if we're talking negative confirmation, we want to details that are going to provide lower level assurance. We want to basically say, this is a situation where we don't need as much assurance to come to our conclusion. So the assessed level of control risk relating to receivables, is that going to be high or low? Which would be the more likely scenario when you need less assurance? When control risk is high or control risk is low? Low, okay? So it's going to be A or B, okay? The number of small balances is high or low. So relative to large balances, would you rather have more small balances or more large balances if you need less assurance? You'd rather have more small balances, okay? You'd rather most of your detail be, because that means there's going to be a lower chance for misstatements. So we're going to say high, which means A, but let's go ahead and talk about this one. Consideration by the recipient is likely or unlikely. So when you're sending out negative confirmations, you're assuming that people are going to look at it, and the only reason they don't respond is because there's no problem. If there's a chance that you'll send a confirmation and they'll say, oh, confirmation, trash. Is that some scenario that you want to use negative confirmations? Do you think that's going to happen? Yeah. Okay. So in that particular situation, we want to make sure consideration by the recipients is likely rather than unlikely. So low, high, unlikely. All those important to consider. 1023. In evaluating the adequacy of the allowance for doubtful accounts, an auditor most likely reviews the entity's aging of receivables to support management's financial assertion of what? So I talked about aging receivables, and I said aging receivables is generally associated with one assertion. In fact, I've never seen a scenario where aging receivables came up in an auditing question that it was not related to this particular assertion. Which assertion is it? VAA. I've talked about it many times in class. Is that intuitively sensible, though, that it should be associated with VAA? What is the aging of receivables? That's when you have to say, okay, here are 0 to 30 days outstanding. Here's 31 to 60 days outstanding. Here's 61 to 90 days. Remember, you all did that in your financial accounting classes. You had to do that calculation, which I'm not going to go into detail about how silly that calculation is. It's kind of, we have better tools now that we could make the aging receivables obsolete. But if we're using an aging receivables, what is the whole goal? It's to say, what do we predict the amount that we're not going to be able to collect is? And it's a certain percentage of each of those buckets. We as auditors evaluate that and see if those are reasonable. So say we look at the 91 to 120 days and they say, we think 1% of those accounts are not going to be collected. I said, oh, so you've got vendors who are over 90 days past due, and you think 99% of those are still going to pay you. That sound reasonable to you guys? Says, oh, that's perfectly reasonable. Client wants to make that number as small as possible. We as auditors have to say, I think that number should be closer to like 50%. Yeah. If they're that far outstanding, then we need to make sure this adjustment. That's what we're kind of considering there as an auditor. All right, moving on to chapter 11. So 1114, when goods are received, the receiving clerk should match the goods with what? Okay, so goods are received, or the receiving clerk should match the goods with what? So let's think about the steps in the process, okay? Purchasing process, there's a purchase requisition, there's a purchase order, and then there's going to be the receipt of the goods. So what should they match to? Probably one of those previous documents that's actually been sent out. So the requisition form could be one of those answers. And I'm not saying it couldn't be a possibility, but it's more likely that we would want to have the approved purchase order, because that's the actual authorized document that says this purchase is valid to have. So C is our answer. Interestingly, something that I alluded to, but we're going to talk about a little bit more. Is it possible that they could validate the items that are received, but not receive quantities on this purchase order? So there's an actual purchase order that was created a while back, and it actually has the items and the quantities, but then they send a copy to the receiving department that doesn't have quantities on there. Is that a possibility? it must be a possibility. I wouldn't be talking about it otherwise. I don't come up with scenarios that are not hypotheticals. Like, no, that's not possible, Dr. Barnes. I said, well, why did I mention it? Yeah. So obviously it's a possibility. Why might we want to give a blank purchase order, a purchase order with blank quantities to the receiving department? Exactly. We want the receiving department to actually count the inventory to make sure that the numbers are correct. Because if they see 10 items, they may just say, well, it looks like 10 to me when there's only 9. Okay. So want to make sure they're doing their work, which might be a reason we do that. That might come up. Okay. That might come up. So there might be some reasons why we see some caveats to something like that. All right. Question number 17. 17. In a properly designed purchasing process, same employee most likely would match vendor invoices with receiving reports and do what? All right, so what step in the process are we doing this? Okay, what step would an employee match vendors' invoices with receiving reports? That's a matching step. We talked about the matching process, like document matching. So it would have to be a step where the invoice has been received. What's the earliest step in the process where invoices are received in the purchasing process? Invoice processing? Everybody on board with invoice processing? Says, no, it's a trick. Dr. Barnes always tricks us. No, it's invoice processing. I'm not trying to trick you this time. It's invoice processing, okay? So what are we going to be doing after that step, okay? Well, what is going to be a logical step? So invoice processing is that an approval step. What do we need to do to make sure approval takes place? Do we post the detailed accounts payable records? No, that's accounts payable. That's the accounts payable step. That's a recording function, not approval, okay? Do we reconcile the accounts payroll ledger? That's just really, really weird. Why do they include payroll in this process anyway? Weirdly weird. Cancel the vendor invoices after payment. Has payment even been made yet at this point? No. Okay, so we don't do that. Could we recompute the calculations on the vendor invoices? Seems like a very, very simple and straightforward step, and that is in fact the correct answer. That's something we want to do. Make sure that the vendor is charging us what they're supposed to be charging us. So yeah, they say 3 items at $15 a piece, you owe us $1 million. And they say, wait a minute, the math doesn't work out on that. Okay. Well, there's a lot of taxes. Okay. There's a lot of taxes and shipping fees. I'm trying, guys. I'm trying. All right. So let's move on. 19. Determine whether accounts payable are complete. Auditor performs a test to verify that all merchandise received is recorded. The population of documents for this test consists of all what? I really like this question, by the way. I really like this question. So accounts payable are complete. We're trying to determine that accounts payable have all the recorded items necessary in there. So the auditor decides to test that anything that was received got recorded. So anything that's received, anything that's basically it's got a document for receipt is going to be in the system somewhere. So we need the source documents. Where do we gather the source documents from if we're trying to test that all merchandise received is recorded? Can't possibly be that simple, can it? It can't be the receiving reports, could it? It absolutely is, okay? We look at the receiving reports. We say, all right, can we find these items that are in these source documents in the system? If we can see where it was recorded, then we have verification of completeness for each of these individual items. All right, that's the easy test. All right, seems like it should be somewhere like you see receiving report and said, okay, merchandise received, receiving reports, there must be a trap. No, it's not a trap. Just using logic to make sure that it makes sense, and it does. All right, 1120. Which of the following audit procedures is best for identifying unrecorded trade accounts payable? That's a really, really complex term, unrecorded trade accounts payable. What's another way we could phrase unrecorded trade accounts payable? What would we as auditors want to do if we think that there's unrecorded trade accounts payable? Would we want to search for those? Would we potentially want to search for unrecorded liabilities? Is that something that we would do as auditors? Is that something that you all did for your homework? Yes, okay. So that's something that we might want to do, okay? So what do we do as part of a search for unrecorded liabilities? Well, let's just go through the answers. Do we examine unusual relationships between monthly accounts payable balances and recorded cash payments? Kind of, but not really. We're not looking for unusual relationships. We're looking for anything that was paid for different amounts. We'll reconcile the vendor statements to the file of receiving reports where we identify items just received prior to the balance sheet date. Is that what you all did for your homework? Nope, it's not. It's not what you did for your homework. You looked at cash payments and vendor balances. We didn't look at receiver reports. Do we want to investigate payables recorded just prior and to subsequent to balance sheet date, determine whether they're supported by receiver reports? Well, B, we just said we didn't look at receiver reports. Did that change anything by saying it a different way in C? Nope, did not. Okay. D, review cash disbursement disbursements recorded subsequent to the balance sheet date and determine whether related payables apply to the prior period. Did you all do that for your homework? You absolutely did that for your homework, and that's the answer. That's what we did. Remember, we were trying to determine, is there a possibility that an unrecorded liability took place because the payment amount looked weird relative to the vendor balance? All right. Last one, multiple choice questions. When using confirmations to provide evidence about the completeness assertion for accounts payable, the appropriate population most likely would be what? I don't know why they tried to actually say for completeness, because you can test multiple assertions. This is more along the lines, if we use accounts payable for or confirmations for accounts payable, who are we going to send those confirmations to? To the customers, right? Okay, is that right? Well, you're going to send them to the customers because the customers have absolutely nothing to do with the purchasing process. They're the ones that generate revenues. So it's not going to be the customers at all. I did want to see if anybody's nodding their head. Thankfully, nobody did. Okay. So that's always what I look for in the classes. People just kind of looking all their heads. Says, yeah, that makes sense, Dr. Brown. So you're not paying attention to a word I'm saying. Yeah. All right. So nobody nodded their head. Everybody's paying attention. We're good. Okay. Actually, that's just it's gonna paralyze you all. Nobody's gonna nod their heads anymore. It's gonna be like, like this. Yeah, or we're just gonna keep your head completely still. Who do we purchase from? Who do we purchase from? What is that? What are those entities called? Start with a V. Vendors. Okay, we're going to send accounts payable confirmation to vendors because we want to know what the vendor balances are. Yeah, that's who we're going to send the population or their confirmation to. That's the population. All right, let's go ahead and talk about some problems now. All right. There are a few questions that are going to be like this in the business process chapter. I really like this one. I don't like some of the ones that are later on as much, but I think this one's a pretty good one. So here's what happened is you've got some audit procedures up here, and they actually talk about the assertions related to the revenue process, talk about the different assertions related to account balances. Now, I want to talk about this because you will notice that they've got rights and obligations, completeness, cutoff, accuracy, VAA, existence, and this last one, it's to ensure that all revenue-related disclosures are in the financial statements, and they didn't even bother to put an assertion. So the reason for this, by the way, this was a new one that was added in the 11th edition, and the editors are really, really lazy at McGraw-Hill. Yes, I said that, okay? Yeah, if they're watching the videos, I called them lazy, okay? But they didn't add this one. Which one is this, by the way? Which assertion are we talking about? So revenue disclosures made in the financial statements. Pretty easy assertion to identify here. At least I thought it was easy. Maybe I've been teaching this class so long that I find it easy, but nobody else does. So what are our assertions again? Got existence, occurrence, completeness, VAA, rights and obligations, classification, presentation. Okay, I saw a nod for presentation. I don't know if Cole was nodding to something else completely different, but it was presentation. Yes, this is presentation. Presentation. Yeah, it's presentation right here. All right. So let's go ahead and go through and identify, based on these assertions, which of these audit procedures would most likely correlate to these assertions. Okay. So ensure the entity has legal title to accounts receivable. So we want to make sure that if we're looking for rights and obligations, we can actually determine what do they absolutely own. Now, this one's not easy. It's not clear. This is kind of the outlier. But one way we could do this is we could look at bank confirmations and loan agreements to determine what is actually stated on those as being part of the ownership. This one, again, is not really clear, but this is number one. Okay. Determine the accounts receivable include all amounts owed to the client. Okay, so we're testing completeness. Now, if we're testing completeness, what direction are we moving? What direction does completeness move? Side to side, Dr. Barnes. You can never be wrong. Or it depends. All those are going to be correct. But no, in this class, bottom to top. Okay. Okay. So that's where we're going to be starting. Source to record. So if we're going to test, if we're testing completeness, we're going to test source to record. Which of these is an example of a testing source to record? What do you guys think? Sample of shipping documents, match them to related sales invoices to determine they have been included in the sales journal, accounts receivable subsidiary ledger. Does that sound like source to record to you all? Okay, does it sound like I'm trying to pull your leg and maybe trying to figure out? Nobody's nodding their heads now. Everybody's terrified. It is three. It is. This is source to record. This is absolutely source to record. Okay. It's okay. I thought you just had something to say. All right. All right. Verify the accounts receivable are recorded in the correct period. This is cutoff. All right. So what are we going to do for cutoff testing? We actually do some cutoff testing. So what do we look at? We look at a few days before and after period end. Yeah. So sample shipping documents for a few days before and after year end. Number 4. All right. Ensure the allowance for uncollectible accounts is properly stated, VAA. All right. So what would be an easy way to check the allowance for uncollectible accounts is properly stated? We probably want to look at what what was the use, how that allowance was generated. What is the document that are the accounting form that you all use to create allowance for doubtful accounts? Again, we just talked about it. So it is 0 to 30, 31 to 60, 61 to 90. What's that called? AR aging. Yes. So on a review the AR aging with the credit manager. All right. Confirm the accounts receivable are valid. Okay. So we want to test existence. Just out of curiosity, if we wanted to confirm something, what would be an easy way to test to confirm something? What type of evidence actually confirms something? Confirmations. Confirmations are a good test of confirming things. Yeah, confirm accounts receivable. Yes. Ensure all revenue liability stage closures are in the financial statements. So this is actually looking at the financial statements, and anything that should be disclosed in the financial statements properly is. So we probably want to look at the financial statements. Does everybody agree with that one? Okay, yeah. Review your drafts of the financial statements, number 2. Again, I really like this test. Other than the first test, the first one is a little bit dicey, but all the rest of these are good associations between assertions and types of tests we would conduct. So I definitely recommend looking into this more in depth as you're preparing for the exam. All right. The next 2 exercises, these are a little bit more fun exercises. All right. These are a little bit more fun, a little more challenging. Let me actually, I think I've got spreadsheets open for these. Or not spreads. I don't have them open, but I've got spreadsheets prepared for these. Where are we? I say that, and then I'm going to completely delete it. Oh yeah, there we go. Okay. So let's go ahead and let's read the description and make sure we know. So we're auditing Ferret Company, and only merchandise shipped by the Ferret Corporation customers up to and including December 30th, 2021 has been eliminated from inventory. Now, this is an important statement, okay? Because this is telling us that there's a separation in journal entries. Now, in revenue transactions under credit, what does the journal entry look like when a sale is made? So a debit to accounts receivable, a credit to sales, okay? That's the first part of the journal entry, right? This is not trying to fool you. I'm just trying to confirm that everybody's on board with this. They remember this from financial accounting. It says, don't know that accounts receivable thing, Dr. Barnes. Could you explain what that is? No. Okay. Make sure accounts receivable, debit accounts receivable, credit to sales, and then we actually have the cost of goods sold inventory. Okay. Cost of goods sold and inventory. Cost of goods sold is debited, inventory is credited. When you learned about this in financial accounting, these were joint, these transactions were joined together. Whenever you had a sale, both of those sides of the journal entry took place. This is telling us that there's a separation in that they may remove from inventory at a different point from when they recognize the sale. All right. So keep that in mind, because that's an important point to make. So the inventory as determined physical inventory count has been recorded in the books that by company's controller. No perpetual inventory records are maintained. All sales are made on an FOB shipping point basis. What is FOB shipping point? Probably important to know that. If you read through the problem and you're trying to answer this question and said, I don't know what FOB shipping point is, who cares? It's probably not important. It's very important. All right. What is FOB shipping point? FOB is freight on board, means that transfer of the inventory takes place when? Like the client owns the inventory when it reaches their docks or when it leaves our warehouse? When it leaves our warehouse, because the FOB shipping point says that when the freight is on board of the shipping point, it leaves our warehouse, the client now has ownership of it. Okay. So that's an important distinction to make. So all purchase invoices have been correctly recorded. Let's go ahead and do some cutoff testing. So we're going to check these and see what's going on. All right. So A, what we got here? We got a sales invoice amount that was recorded on December 20. Or sorry, why does that not pop up? There we go. I'm at the wrong one. My gosh, I'm struggling today, guys. All right. Sales invoice of $3,000 for December 21st. Okay. By the way, you will notice this is recorded in December 2021. So it was recorded as a sale in December 2021. Everybody okay with that? So is a sale that took place on December 21st, should that be recorded in December? Yes, absolutely. Absolutely. So that side of the transaction is good. Merchandise was shipped out on December 31st. Okay. Is there any additional journal entries that need to be made? Well, not so fast, okay? Because keep in mind here, it told us in the problem's details that they did not record shipment of inventory until everything up December 30th has been recorded as a shipment. This took place on December 31st, so it does relate to December, but it has not yet been recorded. So we will need to record a journal entry here to recognize the shipment of inventory. Everybody understand what happened here? because the shipments, the inventory has been recorded up until December 30th. Anything that occurs after December 30th, but it's still in the current year, does need to be recorded. So that's anything on December 31st. All right. Part B. We've got a journal entry for a sale that took place on December 31st. And then cost or good, the sales transaction was recorded. The sales transaction, the cost of goods sold transaction, the shipment was recorded on December 13th. This is properly recorded in 2021. Yes, it is. Would you have any questions about this as an auditor, though? I'd be like, why did it take 18 days when you shipped out the goods on the 13th? Why did it take 18 days later for you to actually record the sale? Shouldn't these be recorded close to the same time? Transaction is fine, okay? The sales transaction is fine. It is properly recorded in the current period, which is the cutoff test. But we still want to know a little bit more about why this took place that way, okay? So auditors should inquire about the delay between the shipment of goods and the recording of the sale. All right, moving on. Got a sales transaction, December 29th for $1,000 and a shipment of goods on December 30th for $600. All right, everybody good with the timing of this transaction? Is it properly recorded in 2021? Yeah, okay, we're good. Any additional journal entries that we need to make? No, the sales transaction was recorded in the proper period, and the cost of goods sold transaction, the inventory shipment, has already been recorded. So no journal entries need to be recorded. No adjustments necessary. All right. Part D. All right, we have a sale that took place on December 31st for $4,000, and the goods were shipped out on January 9th for $2,400. All right, so should this take place in December, this transaction, the sales transaction take place in December 2021? Well, they recorded in December 2021, but what do we know about performance obligation? Performance obligation is met when the goods are shipped to the customer. When do the goods get shipped to the customer? In January, okay, in January 9th. So when should this be recorded as a sale? Into 2021 or 2022? 2022. But they've recorded this as a sale for 2021. So what do we have to do? We have to reverse that, okay? It cannot be recognized as a sale. So how do you reverse a sales transaction? You debit sales and credit accounts receivable. So Dr. Barnes is telling us to debit revenues. I'm storming out right now. Going to go complain to Dr. Eisen and Dr. Deers right away. No, this is legitimate because this is recorded incorrectly. All right. Part E says we got a transaction for $10,000 recorded December 30th. The goods were shipped on December 29th. This is a transaction that looks pretty good, all face value. Everybody good with this transaction? Oh, what does consignee mean? That's right. All right. So consignment is really important to note. So consignment basically means that if you're sending goods that you own to a consignee, you still have ownership. It's like a little bit like a personal eBay. Okay. You basically give them to an independent party. They try to sell the goods for you, but they don't own the goods. They're just selling them on your behalf. So shipping to a consignee does not change ownership of goods. Similarly, if you're a consignor, if you take possession of goods, you don't own those goods. You're just selling on behalf of another party. So think of it about like selling on eBay or selling on an online marketplace. They're not the ones who own the goods. You're still the one who owns the goods. So it looks like this has been recorded. We need to flip this entire journal entry, it looks like. Flip that entire journal entry. Debiting revenues again. Dirty, dirty practices right here, I tell you. All right. Now we're moving on down to January, okay? January of a sale for December 31st and shipment of on December 30th. Should this have been recorded in 2022? Everybody's completely confused now. When did the goods get shipped to the customer? December of 2021. When should the sale be recognized? 2021. It should be recorded, but it was not recorded until 2022. So this is not correct. We need to recognize it in 2021. So we're actually going to record this journal entry right here. Why did I not record the entire journal entry, the cost of goods sold in inventory? Because the shipment took place on December 30th. And what did they say in the facts about the shipment? They said that all goods have been removed from inventory that was as of December 30th. So the other side of the journal entry has already taken place. We just need to record the sales entry. All right, part G. Sale on January 2nd, shipment of goods on January 2nd. What do you guys think? Is this correctly recorded in 2022? Yep, we're good with that. All right. Part H, sale recorded on January 3rd, goods shipped on December 31st. What do you guys think? Should this have been recorded in 2022? No, it should not. Shipment of goods took place in the previous period in 2021. It should be recorded in that year. So when the auditor, we're telling them to make adjusting entries, they've got to do the entire adjusting entry, both sides. Why did I tell them they only had to record one part of the journal entry in part F, but they have to record the entire journal entry in part H? What's the difference? So this one took place on December 30th. What did the case say about goods shipped as of December 30th? They've already been removed from inventory. This is December 31st. Has this been removed from inventory yet? Nope. So we have to do that. We have to remove this from inventory down here. All right. You guys seem really enthusiastic and like really excited about that. What do you guys say we do some more of this? It's too bad. We're going to do it anyway. All right. Too bad. We're going to move on. We're going to do another cutoff test, but this time for the purchasing process. This one's a little bit easier to digest. Okay. So you're doing an audit of the Giordani Corporation. You decide to form cutoff for payables and accruals. Select all items greater than 25,000 for 2 business days before and after year end. Okay. You will note that the last receiving report number for 2021 was 49745. Why do we care about the receiving report number? Yeah, it will actually allow us to infer the date or a sequence. Because remember, numbers should be sequential. So anything that was before 49745 should occur in 2021. Anything after 49745 should occur in 2022. Does everybody understand that logic? So that sequence of numbers is really important here. All right, so let's go ahead and look through these. And of course, I've got another spreadsheet to work through. All right, so receiving report 49742. You guys okay with the receiving report number here? Does that correctly take place in 2021? Yes, this is before 49745. So we're good with this, okay? We're good with this particular item. Allen Chemicals, 29875, okay? Chemicals purchased from the manufacturing process. This is recorded as a purchase in 2021. Is it correctly recorded as a purchase during that period? Well, it meets the receiving report test. It's before our last receiving report number, okay? And it looks like it was recorded on December 30th, so I'm okay with this. There's no adjustments necessary. We can go ahead and move on to our lives. All right. Con Consulting for $45,000. There's no receiving report number. Why is that? It's a service. Yeah, we generally don't put services in a warehouse. Okay, so we don't have to actually receive those services. Payments for consulting services for the 3-month period beginning December 1st, 2021, $45,000 was charged to consulting expenses. You guys okay with this? This is all recorded as an expense in 2021. Is that cool? No, yeah, that's an old thing back to the adjusting entries you learned all the way back in 2020. If it's a 3-month period, we have to record part of it for 2021, the first month, and the last 2 months for 2022. So we actually have to make an adjusting entry. What are we going to do? We're going to do something that you're probably not going to like. We're going to credit expenses. All right, time to storm up to Dr. Caden. Says, you can't believe what Dr. Barnes is telling us. He's debiting revenues and crediting expenses. And she's a tax accountant, so she's not going to know what any of that means. So yeah. Yeah, so you have to go play Dr. Ice and Dr. Deers. Boy, I'm just torching everybody today. What can I say? I just need to say something rude about Dr. Terra now. Yeah. All right. So what happened? Well, they recorded consulting expenses as a debit for $45,000. All right. And they probably recorded cash because they paid that or were the accounts payable. Only 15,000 of this should have been recorded consulting expenses. So we're going to back out the consulting expenses for $30,000. 15,000 is fine because it was the first month. And we're going to accrue this in prepaid consulting expenses. In January and February, we'll recognize the remaining $30,000. So that's why this journal entry looks like that. All right, part C. Goff Materials, $205,000 for raw materials used in the manufacturing process. What do you guys think? Does that journal entry look, or does that transaction look legit? Yeah, I'm happy with that. Okay, we're happy with that. All right, moving down to D. These are transactions that are recorded in 2022. So they purchased a new forklift on receiving report number 49746 for Temper Trucks. Okay. Anything wrong with this transaction here? Should it have been recorded in 2022? Yeah, I think so. Receiving reports after the last receiving report in 2021. So we're happy with this. This seems reasonable. So no adjustments necessary. All right. So 49743, pack products for paper products used in the manufacturing process. This is recorded in 2022. Is that cool? No. What's the biggest clue here to tell us that we got the problem here? So receiving report number. This receiving report number occurs before our final receiving report number in 2021, meaning that it took place when? 2021. It had to have affected because there's sequential purchase order number or purchase order numbers or receiving report numbers, excuse me. So when should this be recorded? Should be recorded in 2021. So let's make that entry. What's it going to look like? I honestly don't know why they do supplies because it seems like this should be for manufacturing, but that's what the answer key told me to put in there. I don't like that answer. I would never give you this answer in reality. Accounts payable is fine, but I'd probably put some sort of raw materials or something like that. Why do you always do what people tell you, Dr. Barnes? Says, I don't know what else to do. I don't know what else to do. All right. December 2nd, no receiver report number for telecom. So this is a service, so it's fine that we didn't actually receive anything, but we charged $32,450 for December 21st telephone, December 2021 telephone bill. What do you guys know about matching of revenue expenses? When should this take place? In 2020 or 2021? Or 2021 or 2022? 21 should have been in the previous period because we try to match expenses, even if we only had to make an estimate. But since we know that amount now, we're going to record that amount. Telephone expense and accrued expenses. I don't know why the accrued expense is there either. It seems like it should be an accounts payable. Again, I just basically copied the answer, but it's more about the intuition. So yeah, some interesting cutoff tests. If you had trouble following those, I definitely recommend that you review those for the exam. I will probably ask you some questions about cutoff testing on the exam. Maybe not to that level of detail, but something still important to remember. All right, last to wrap up. You guys had some unrecorded liabilities to test. So here we have some payees that received cash at period end or right after period end. What did we talk about? We said that if these people are receiving cash, then it should be for amounts that they're owed, right? These are vendors that are supposed to be owed cash. So let's go ahead and let's work through these and see what kind of situations we have. So we've got Apparel Concepts that received $254,032. All right. If we go and look at Apparel Concepts over here, they are owed $434,000.32, or $434,032.32. I'm just going to put the 32 cents in there just for giggles. All right. What do you guys think? They were paid part of what they were owed. Is that okay, or is that a problem? That's fine. Okay. We're paying part of the vendor balance. They're paying part of the vendor balance. So we're just going to put that tick mark right there. Okay. By the way, just so you know, there are 4 possible tick marks. F and S we would not use. That's actually for footing and scanning. That's actually been used down here. All right. So we're only going to use one of 2 tick marks. We're going to use the circle with a slash through it, or we use a triangle if we think there's a problem. American Apparel. American Apparel. Let's go ahead and take a look at this. Okay. American Apparel, $25,407. They were paid exactly what they were owed. How do we feel about this auditors? We're happy with that. Get paid exactly what we're owed. Yeah. All right. I'm just going to keep putting circles down here until you guys tell me to stop, okay? I'm just going to keep putting circles down here until you tell me to stop. I'm just going to keep putting circles down here until you tell me to stop. Oh, wait, is there a problem on this one? All right, so Lewis Hardware, okay? All right. Lewis Hardware. Where is Lewis Hardware? Somebody remove Lewis Hardware? Brett, were you responsible for removing Lewis Hardware? Lewis Hardware does not appear to be owed any money. Why are we paying them money? That's an interesting question. Should that be a question that we pose to somebody? All right, so put that there. We're not saying there's an unrecorded liability. We're saying, look, we don't know why there's a payment going on here. We don't know why there's a payment that occurred here because they don't owe it. They're not owed any money. So we need to investigate that. Possibility of an unrecorded liability. All right, I'm going to keep putting circles up here until people tell me to stop. I'm going to keep putting circles up here until people tell me to. Oh, this one right here, the 40,501. No, this one right here, Stevenson promotion. I've actually got the solution in front of me, but I'm just trying to troll you, Hudson. Stevenson promotion. All right. $69,291. They were paid $157,206. So just out of curiosity, when you owe somebody money, are you in the habit of paying them 2.5 times what you actually owe them? Anybody do that? I want to be your friend if that's the case. Yeah. You say, I'll loan you money so I can get like a 150% rate of return. Yeah, so they paid them a lot more money than they were owed. Why would they do that? Don't know. We want to ask questions. Is it possible there's an unrecorded liability? Yes. So let's find out. Let's find out. All right. Well, I seem to be a little bit overzealous. So is it okay if I put a circle here? Yes. Okay. What about this last one right here? Intermountain gas? No. Chandler says no. Okay. The thumbs down. Thumbs down. All right. Let's take a look. Intermountain gas. Industria Americana. It's close, but it's no cigar. There's no Intermountain gas. So again, same problem as with this one up here, Lewis Hardware. Shouldn't be paying money to vendors that they don't owe money to. So we want to find out what's going on here. So in the end, we have three circles. Then we've got a delta symbol, then another circle, another delta, another circle, another delta. So we got three possibilities. What does this tell us? It tells us we need to go talk to our client. We need to say we found three vendors that were being paid money that was either in excess of what was owed, or they didn't currently have a balance. We want to know why you were making payments to these vendors for those amounts. That would be our next step in investigating. That's what this tells us right here. Yes.
Would you still flag it if there was like a payment for that amount, but the name was different, like the name was like different or like slightly different, or we can just make an assumption?
If the payee is different, I'd want to know, like, say, for example, they made a payment to a payee, but it was like under a different name. Like, say their vendor name is listed as Intermountain Gas, and this one was like saying care of a subsidiary name or something like that. I'd want to know why is payment being made to a different name. I'd still want to investigate it. Yeah, but yeah, good question. All right. Well, I guess that does it. Unless we got anything else, you guys can enjoy your weekend. Audit free, unless you have to work on Excel.